I guess what's confusing probably, Richard, to a lot of our viewers is that they hear these CEOs saying that things might get bad or going to get bad or are likely to get bad. They got companies, some of them are cutting their sales forecasts, and yet we keep talking about raising rates because of inflation. And I guarantee a lot of people watching and listening right now, Richard, they don't believe it. They're like, no way. The Fed has never gotten tight. They're going to go back dovish. They're not going to let the markets collapse.
It's not so much a market collapse as it is rediscovering price discovery. When money is free, everything looks good. And they went on this bent for too long. Powell has been reappointed. I know the man's character. I haven't talked about policy with him for some time because we're not allowed to talk about policy. But he doesn't want to be Arthur Burns. Nobody wants to be Arthur Burns. And I think he's determined now that he has been reappointed, by the way, with a significant support on both sides of the aisle in the Senate, which is very important. He actually beat the president on Capitol Hill because I don't think the president really wanted to reappoint him, but that's a fact. And I think he'll do what is required. Right now we have still, we'll see what the numbers are as they come out, but the amount of unemployment claims are historically low. We're seeing a restoration of, or at least the consumer seems to be weakening, but still fairly strong. We have more people looking for workers than we have workers looking for jobs. There's leeway here. As far as the markets are concerned, the markets have gotten lazy. Free money allows you to discount the present value of future cash flow to infinity. That's over. So now the interest rate sectors in particular, I think, are going to pay a price.
Hey, Richard, and nobody wants to be...
Not down the hatches. Go ahead, please, Becky.
Well, I'm sorry. Nobody wants to be Arthur Burns, but nobody necessarily wants to be Volcker either, at least in the immediate after effect of what that means. Are those his only two choices here? Because we are grateful for what Volcker did, but at the time it was really, really painful.
Yeah, Becky, you don't want to go as far as Volcker did, but Volcker had to do what he did because the things were really completely out of control. They're not out of control. They just need to be tempered down. And you don't want to be in either position if you're in that chair, or you don't want to be in either position if you're on that committee. But they did let things go too far. The horse got out of the barn, and now they have to bring it back. And they're going to have to do so convincingly. Remember, part of what they're doing here, if you look at what Ms. Brainerd said yesterday, I thought was very good, or what Ms. Muster said yesterday. They're talking to the market. They're hoping the market will do some of the work. I'm talking about the fixed income markets. You signal by what you say, because what you say has power when you're at the Federal Reserve. So I think it's a combination of two. One is action, delivering on those action, making clear what you're willing to do. We've never seen this before, where you announce a couple of 50 basis points, as Lael did yesterday, ahead of time, and other committee members, or the chairman saying, here's what we're going to do at the next meeting. They're giving you as much advance notice as possible. And in saying what they're saying, they're reaffirming that they mean it about inflation. So it may be, by having signaled this strong a policy, that they may not have to follow through as much if, indeed, the markets and the economy react to their words. So it's a two-pronged. Go ahead.
You don't want to relitigate the past. I get it, because we are where we are, Richard, and the house is on fire, and we're talking about how to put it out, and I get that. If you had to, though, go back and say, what was the biggest policy error? And you're in Texas, and I bring that up for a reason. I don't want to get into the politics of masks or lockdowns, but here's the reality. Here's what I think, Richard. If the Federal Reserve would have just taken a field trip to half the country, besides D.C., New York, Chicago, that pretty much either didn't shut down or didn't shut down for long, they would have realized that the stimulus that they thought they were doing was not needed in many places. Is that a fair statement? That they sort of saw the whole world from a D.C. perspective when half the country either didn't lock down or locked down for a couple weeks, not 2 years like Washington?
Well, I was part of the team that advised the governor to get rid of masks quickly and to reopen the economy. I believe we were the first. We're a large economy. We have almost 13 million workers and 30 million population base. And we saw the effects. And by the way, in April, according to the Dallas Fed, employment growth in Texas, in the Federal Reserve District, the 11th Federal Reserve District, which is 99% Texas, was 5.7%. So it's still continuing. If you look at the different states, You cannot have a recession, as others point out, unless you get many states reporting negative numbers. We're not seeing that yet. So it continues. We have a wage price spiral. The Fed could have noticed this, although I'm sure they were getting reports from the regional banks. And yes, I believe the decision model they took, which is what I call the horse out of the barn model, was the wrong model. They now are correcting for it. They realize that. And I think they're listening carefully to the micro data, because many micros make a macro. And this Texas economy is a big micro factor, and it's still growing like gangbusters.
Shepard Smith here. Thanks for watching CNBC on YouTube.